kickstarting the crowdfunding business. For this week's Smith Business Close-Up, we're on location at the University of Maryland's Robert H. Smith Business School. And joining us is Professor Siva Viswanathan, an Associate Professor of Information Systems and Co-Director of the Center for Digital Innovation, Technology and Strategy. Thank you for being with us.
Oh, it's a pleasure. Thank you for
crowdfunding. What is meant by crowdfunding?
So crowdfunding is part of a larger phenomena called crowdsourcing. And crowdsourcing is nothing but leveraging the crowd for a number of different activities. So you could use the crowd for labor, you could use the crowd for creative tasks like t-shirt design, let's say logo design or a website design. You could use the power of the crowd for coming up with innovative solutions. And crowdfunding is about using the crowd to tap the crowd for resources, for funding, for financing your startup or new venture. And crowdsourcing in general is not something that's very new. If you think about it, it's probably one of the oldest forms of transacting. We've had crowd-based markets since ancient civilizations. And this is just coming back a full circle.
It's maybe gotten a bit easier to connect to the crowd with the internet and websites like Kickstarter. How does that work?
So essentially, if you're an entrepreneur, you want to raise funds for your venture, you would put up a listing on one of these crowdfunding platforms, and you would put up a lot of information about what this project is about, what you need the money for, how you're going to use the money, and so on and so forth, and let all the potential investors look at this information and decide how much to fund you and what's the return on investment that they get. So in some markets, you would have a fixed return on investment. In some places, you might get a free sample of the product. In others, you might actually get return on investment depending on how you bid on these listings.
Any success stories so far with websites like Kickstarter or others?
Oh, definitely. There have been a lot of crowdfunding markets that have evolved over the last few years. Kickstarter, of course, is a very popular one. There have been projects that have been very successful in raising millions of dollars on these platforms. But the earliest ones were the ones like Prosper, which were essentially debt-based markets. So people would invest in these ventures and get a return on investment as opposed to get a sample of the product or, let's say, a ticket to a music concert.
What are the regulatory issues with actually raising money in this way?
So interestingly, so far, none of these markets have been regulated, and which is typically the case with early startup. What we find is the SEC is now starting to bring in some regulation. So what we'll see is the growth of equity-based markets. So what's currently happening is the SEC is debating rules about rules for these equity-based markets. And within the next few months, we should see these rules being finalized. And then these markets will start to be regulated.
What's your sense of where it goes from there? For what types of ventures would this be a wise avenue to explore in terms of fundraising? And the flip side is people who are considering being part of the crowd, what should they think about?
So one of the biggest problems with these kind of markets is, of course, there's greater risk. So whenever we think about the term crowd, there's a misconception that these are not experts or the crowds lack expertise. But what we find in our studies, we've studied a number of these online crowdfunding platforms, and what we find is the crowd is very sophisticated in making decisions. They're actually able to pick out the really successful ones, the ones that are really doing well, and invest in those, almost as on par with an expert. And this is something that's very interesting because you don't think of crowds as being experts. And whereas even in the traditional setting, only about 25% of the startups actually do well. There's a 75% failure rate. So we would expect about the same in these online markets, except that there's greater risk because there's less information about these startups. These are national markets, these are global markets. So there's lesser information, and that's greater risk for the crowd.
What are the regulatory issues with the fact that it is a global market and can exceed the SEC's jurisdiction?
Currently, the equity-based markets will be national markets as opposed to global markets, so they will still be under the jurisdiction of the SEC. I guess when it becomes global, then that's a completely whole new range of issues that will probably crop up.
If an entrepreneur is looking at this, not even necessarily for a for-profit venture, for some sort of venture, what are the keys to making it work or knowing if your venture might be appealing to the crowd?
One of the interesting things is how these markets are designed. So for instance, different crowdfunding markets have very different designs in terms of what kind of information do they make available to potential investors. And what we find is that these differences in how these markets are designed make a huge difference in how successful these markets are. Is the crowd able to make the right decisions? And even making a particular piece of information more transparent or less transparent has a very significant implication. So I would think it's more about the design of the market as opposed to the individual participants, because what we find is given the right information, people are able to make the right decisions.
All right, Professor Siva Viswanathan from the University of Maryland, thank you for being with us.
Thank you very much. It's a pleasure.